Hey guys, welcome back to the Grant Mitt Podcast, episode number 112. And in this episode, we're going to be talking about how to build wealth and how the actual monetary system works. The world and the world economy, nobody really talks about it. And we've all been through school. Some of us have been to universities or through college, and we don't even have an understanding of how this system works. So if you're trying to build wealth, no matter where you're from, no matter what type of business you have, one of the most important things is first just simply understanding how the system works, right? So let's talk about it. Who controls the money supply in the world? And what is the reserve currency? The United States, a little bit right around World War II, became the reserve currency of the world, meaning that most countries that save any sorts of capital, have any sort of reserves, they actually save that capital in United States dollars. And then the bulk of international trade for oil, for tech, for any trade between countries is typically done through US dollars. So because that is the case, no country has more effect on the world economy than what the United States, their political policy is, and what the Federal Reserve is doing. Now, the Federal Reserve controls two massive things that control the levers that affect every single business and every single exchange of value in the entire world. One, they control interest rates. Okay, that's the rate at which anything is borrowed. Okay, the second is the liquidity, the amount of dollars that are circulating in an economy. A simple way to look at this is first is supply and demand. Picture that Ferrari. Let's say Ferrari has this special Ferrari that's $1 million, and they only make 300 to 500 of them. But then suddenly, because it had so much success the first year, the second year they said, you know what, we're going to make 50,000 Ferraris. While they could probably sell those 50,000 really quickly, what would happen? The value of those cars would tank. The brand value would tank, no different than Toyotas are much cheaper than a really high-end luxury car. The same thing works for dollars. So traditionally what happened, and you can go back even to the Roman Empire, and a lot of different empires that existed before the United States was the most powerful country in the world. And one common driver is, yes, it had to do with foreign conflicts, it had to do with the wars, but more than anything, it was actually heavily based on the economy and the way that they operated their financial system. The United States, up into the late 1800s, operated off of a gold-backed currency, which means every single note or dollar bill that was exchanged between people was actually backed by gold. Meaning, and this is even crazy to think about, there was a point in time when you could actually take $100 or $10,000 and exchange it for actual real gold. So when you're exchanging things, think about if you look at gold, why does gold value always go up? Because there's a limited supply. It's something that people see as value. There's innate value to it. There's a limited supply. And because all the other Federal Reserves, especially driving the United States, keep printing more money, there's a limited amount of gold prices go up. But before you had a fiat currency, you had a gold currency, it was limited. So when you hear people say things like, you got to save your money, a lot of that stems from two different perspectives. The first is a gold-backed currency, which we used to have, where if you saved money, your money would become more valuable just by saving it. Yes, people still invested. Yes, people still started companies. But if you were holding dollar bills, your wealth was being preserved. Okay? The next is we used to have extremely high interest rates. In the 80s, it got almost to 20%. So if you were leaving your money in the bank, your money would grow actually quite a bit. But getting a loan, getting a home, a mortgage, all that was very expensive. Money was very, very expensive. So a couple things that happened. In 1933, FDR made an announcement and departed from the gold standard. This was right after the Great Depression. This gave the United States the ability to enter more dollars into the circulation to use for government-funded buildings, for example, like the Hoover Dam that they built, and pumping more money into the economy for social services, all different types of government works, okay? Then in 1971, Nixon jumped on the screen. I'll put it in the link below so you can actually watch the video at some point. But Nixon got on the TV and basically announced that the United States is going to terminate the convertibility of the US dollar into gold. Like I said, at one point, we used to be able to exchange US dollars for gold. He eliminated that. This basically pulled off all the reins for the government to basically, they can now print and enter as many dollars as they want into the circulation. If they sign a bill or the Federal Reserve says we're going to add $2 trillion, boom, it immediately enters the market. Now, let's think about this, right? How does the Fed's decision affect you? As everyone here, I'm sure you remember, right before COVID and into the first year to year and a half of COVID, the Federal Reserve dropped interest rates all the way down to 0%. So at that time, you were seeing people getting homes, getting cars, lines of credit for little as anywhere between 1% to 3%. For us in the solar market, many times we had 0% interest loans. They had really high dealer fees, but we were regularly selling 199, 299. You would never even see a 399 loan. And so when this happens, when they drop interest rates, the point is to cause people to borrow more. Okay, one man's debt is another man's asset. So if more people are able to borrow large sums of money at a cheaper rate, that money that they're collecting, they're going to spend. So for example, if you go out and get a $50,000 loan for a car, remember that's one man's debt, and that $50,000 now becomes basically revenue to the dealership. They pay Ford or Chevy or Cadillac or GM, whoever it is, and then they take their $10,000 profit, they pay the sales guy, they pay everyone that works there, and they turn a profit. And then the money that everybody earns from those things trickles into small businesses, into oil and gas, into mortgages, into restaurants, into bars, into every other aspect. So the cheaper the interest rate, the more people are going to spend. You see this when any country enters recessions. They typically drop interest rates extremely low to increase borrowing, increase spending, so it trickles down into every area of the economy. Then what happened is, if we look back at COVID, and if you go back in 2021, I made a podcast. It was like how the investing and managing money in 2021, something like that. It was one of my first 10 podcasts, and I talked about how interest rates were extremely low. And because the government had spent so much money during COVID, we were going to see rapid inflation and we were going to see asset prices inflate. That's what happened. And so what happened is, at the end of the Trump administration, and I'm not going to be super political, I'm going to be pretty factual here, is the end of the Trump administration, right when COVID hit, we had no choice but to get a bill to fund all of these companies and then also send out rebate checks to everybody. They did this. And at the end of the Trump administration, they spent about $8 trillion, which was massive. And they weren't spending remotely even close to anything like that until we had no choice. We had essentially every single company was shut down, could not operate, and they still had to pay mortgages, they still had to pay salaries, they still had overhead, utilities, you name it. So they funded all of these businesses. And then into the first 2 years of the Biden administration, he spent actually close to $9 trillion. This was on the Build Back Better deal. This was on the Inflation Reduction Act, which was a $3 trillion bill, which oddly helped create inflation. It's ironic that they called it that. And they entered so much capital into the markets. And so when you look at the amount of US dollars that are circulating in the world, more than half of them were created in the last 5 years. You don't have to be an economist to know that that is not good. And so what happened is, because you doubled the liquidity, or almost doubled the liquidity, everything goes up, the asset prices go up, but also all of everyday spending goes up as well. Eggs at the grocery store, gas prices, rent prices, everything almost doubled everywhere in the United States, further destructing the lower and the middle class. And really even people that were upper middle class have been hit so hard because incomes did not rise as quick as inflation did. Okay? So anytime you hear the Fed is dropping interest rates 0.25% or 500 basis points, all that's going to happen is when you go get an auto loan, when you apply for a mortgage, it's going to trickle down into those areas and you're going to start having lower interest rates. Okay, if you think about a mortgage, before COVID, the average home price was right around $225,000. Now the average is about $450,000. and the mortgage payment between the two, not even necessarily because of the asset price going up, but because interest rates more than doubled, you could get a average home in America for around $2,000 for a mortgage. Now that same deal is over $4,000. So the amount of people that qualify to buy it dropped like crazy. And so that slows the economy, and it trickles down into everything that's supported on it. So let's talk about how inflation works, and then I'm going to talk to you guys about how to actually build wealth, okay? Because I'm explaining the system, but I'm going to break down how to actually build wealth, okay? Inflation is simple. It's just general prices increasing over time. Now, if you go back, I've seen different things. I'm sure you have as well. A Ford plant worker on a full salary, okay, and we're talking like on the assembly line. We're not talking about like an executive, a manager, a vice president. We're talking about a plant worker back in the 50s. A single or one man that has a family, has 3 kids and a stay-at-home wife, could afford a house, car, plus savings. Had no worries. And now we're seeing the lower and the middle class completely destructed so much that 73% of all people actually live paycheck to paycheck. 86% of businesses either break even or lose money. So how in the heck do you build wealth? Let's take a look at these prices, right? Number one, an average home price in 1980 was $68,700. Today, it's $412,000. Movie ticket, 1980, $2.69. Today, average is $11.45. Gallon of milk, 1980, $1.24. Today, it is $3.59. Okay, look at this car, man. This doesn't even seem real. A car in 1980, $7,211 was the average price. Today, $47,000. I remember being a kid, and if you had a $40,000 or $50,000 car, you were rich. Loaf of bread, 50 cents. Now it's $2.50. Okay, so what's happening, and there was this great interview from Paul Tudor Jones. He runs one of the largest hedge funds in the world. He's an incredible investor. And he was given this interview on CNBC, and he said, all roads lead to inflation. He's like, I'm long Bitcoin, I'm long commodities, I'm long this. And what that means is if there's a Democrat that's president or a Republican that's president, so far we've seen this over the last 100 years, the politicians are going to continue to spend like drunken sailors. We're going to have catastrophes, we're going to have issues, we're going to have pandemics, we're going to have wars, and all roads are going to lead to the government continuing to operate at a deficit and the government continuing to print money that we don't have. But the thing is, the only reason we're able to do this is because we're the military power of the world, and as of now, and they need to get spending under control, we're going to lose this, the United States is going to lose this, we're the reserve currency of the world. So when you have all of these things here, you can kind of get away with doing this, and you don't feel, for example, in the United States, you don't feel the inflation as much as other countries. So let's think about this. Like right now, the revenue of the United States government this previous tax season was about $5 trillion. We had a $7 trillion budget, which means we operated at a $2 trillion deficit. Now, where the hell did the $2 trillion come from? Well, it didn't come from taxpayers. They created that money out of thin air. You go, wait, they can do that? Yes, they can literally put digits on a screen and bam, there's now $2 trillion more dollars to cover their costs. And then eventually they trickle down and circle into our economy and throughout the world. The problem with this is one thing. And if the bulk of the world understood this, they would be rioting in front of the Capitol today. But they don't. They don't think about it because they're so worried about the problems today, and rightfully so. You can't blame them. But each time we operate at a deficit, which so far we have a 23-year streak of being or operating at a full deficit. 2001 was the last year. That more liquidity hits the market, it causes more inflation, and the purchasing power of a dollar drops even more. There was nothing more financially stupid than only not investing in anything and only saving US dollars. This is different than a cash reserve. This is different than emergency fund. This is different than operating costs. You cannot build wealth saving money because you are saving something that is losing value every single year. Right? We just went through the numbers, right? If you had, for a home, for example, if you instead of purchasing a home, which that's a whole other conversation, I think it's only an asset when you got a renter in it, but it doesn't matter, another combo. If If you save $68,000, I mean, if you're getting 1% interest on this, like, I mean, you're sitting at probably, I mean, I got to have to do the math, obviously, but you have nothing. So what's the antidote to all of this? Okay, when the government prints capital that it doesn't have, it kills purchasing power. Okay, so there's a simple thing, all right? You have to buy assets. Assets are the antidote to inflation and the destruction of our purchasing power, not only in the United States, but everywhere in the world. We have a fiat-backed currency, which means it is backed by nothing. Okay, you can argue, I guess you could say the military, but there's no intrinsic value. It's paper currency. It's digits on a screen. Boom, they could double it tomorrow if they wanted to. So it's absolutely destructing the lower and the middle class, and the wealthy owns assets, so they just get richer and richer and richer. So how do we do this, all right? Let's talk about first compound interest. Okay, Albert Einstein once famously said that compound interest is the eighth wonder of the world. If you get a 10% return year over year, it only takes 7 years to double your money. And so the key is you have to start letting your money work for you. We all, no matter how much money you make, let's listen to this right now, you, your family, everyone you know, we always find a way to pay Netflix. We always find a way to take that girl on a date. We always find a way to go get drinks with our friends. We always figure out how to buy a new iPhone. We figure out how to pay for our car, pay for our rent. But do we always take that seriousness on paying ourselves? Money will work for you if you put it to work. And you have to invest in things that you specialize in. But what are assets, okay? And what are some things that we can invest in, right? I'm not going to tell you, hey, do this stock, buy this thing. But I'm going to give you the basis, and then you go do your homework and get to it. So first is a great assets are Bitcoin. 2 is stocks. You look at the S&P 500. Index funds, which are accumulation of really great companies that average about a 10% return. You got real estate, that could be land, that could be single-family homes, it could be multifamilies, it could be apartment complexes, it could be commercial buildings, it could be infrastructure projects. So you go down the line and you start noticing all these things. It could be also private equity in businesses. It could be venture capital. It's moving money into things that will grow. And compound interest is incredible. And I'll put a link also below for a compound interest calculator where you can actually input your starting amount. It could be $10, it could be $1. And then how much money you actually put into that investment account or into any asset every single month. It could be $50, $5,000, $5 million, whatever it is. And then you set the rate of return that you get each year, and you get to see how your money will grow. And they don't teach us anywhere. It's just mind-blowing to me because it doesn't take a lot of money to get really wealthy. It takes time and it takes consistency. And it takes discipline. So let's talk about this, right? First one is, let's say that an individual, and you can look this up, you can input this and you'll see it. It's just math, right? It's not hope, it's just simply math. Let's say an individual starts with $1,000 in an investment account and they commit to putting $500 per month into assets that average a 9.5% return. You go, well, 9.5% return, what about down years, up years, Grant? Where I'm getting that number is the United States stock market, including the Great Depression, all the recessions that we had, crash in 99, I think it was 84 was a big crash, and then 2008. All these things that have occurred, it has still averaged over a 9.5% return over the last 125 years, okay? So $1,000 initial investment, you put only $500 per month, you average only a 9.5% return, which isn't crazy. Starting from zero, in 35 years, you're going to have $1.697 million. Okay, so the only thing you did, $1,000, you put $500 a month, and you don't touch it. You get 9.5% year over year. You got basically almost 1.7. Now look at the difference here. The next one, you start with $1,000, but you put $2,000 a month. And other people are like, well, I don't know if I can do it. We afford $2,000 for a lot of us for our rent. Some of us pay $10,000 rent, $5,000 rent, $3,000. Okay, so if you could find $2,000 to pay yourself before you pay anybody else with a 15% return, in 35 years, you're going to have $29.3 million. Now, this is assuming you don't build this unbelievable company. This assumes that you're not the highest producer in your industry. This assumes you're not doing something crazy, but you're being consistent and you're allocating money towards assets. Someone that's putting $1,000 starting dollars, $2,000 a month at a 15% return is going to have 30 mil in 35 years. And you can do the math, like I said with the link below. It gets pretty crazy. You have to let your money work for you. And it's a simple process, okay? So I'm going to give you like just the simple 3-step process to getting really, really, really wealthy. Number 1, generate income from a skill set. Okay, you could be a plumber, you could be an electrician, you could be a salesperson, you could be an engineer, you could be a small business owner, you could be a consultant, you could start a small business. Learn to become the best of the best at what you do and make great income from it. And before people are like, well, I don't know the right people. I still don't even feel like I know the right people. Nobody's rescued me. I've met some of the most successful people in the world, and I haven't made any money by knowing them. I've made great money from hiring really great salespeople, managers, finance people, accountants, lawyers. That's how you make money, not by knowing a famous person on the internet. Okay? So learn a skill set and be great at it. Right? 2, earn a profit from what you do. It doesn't matter if it's 10% profit, 50% profit, meaning you got your operating expenses for your kids, your family, your food, your shelter, your car, insurance, you name it. And then you turn a profit. What most people do with that profit is they buy designer. They buy nice shoes. They buy Rolexes. They buy cars. They go on trips. And I want you to have a great life and enjoy yourself. But if you want to get wealthy and be able to do whatever you want whenever you want, we need to start letting our money work for us because we already work for ourselves. Time, energy, effort, focus, stress. But when the money's working, the money doesn't stress. It just works. And it works fast. And it doesn't stop 24/7. Okay, so earn a profit. Convert that money. Remember, you're taking a depreciating asset, which is the United States dollar bill, wherever you live. And if you're in a different currency, it's depreciating even more. And you're converting that into an asset that is going to inflate in value. Okay, without the asset intrinsically improving, naturally asset prices go up just off of sheer inflation. And this isn't a topic or a conversation about Bitcoin, but Bitcoin has really clicked for me in the last 5 years because I realized, are more people investing in it, of course, but it's actually just reacting to the destruction of the United States dollar. That's why if you go look at Bitcoin's price compared to some of the pesos and the weaker currencies in South America and other places, Bitcoin is at some crazy price. And so the more that the government decides to print money, the lower the interest rates are. Like I went on Fox and I told people, a year and a half ago, and I said, we won't see another Bitcoin bull run until they start dropping interest rates again. As soon as the Fed announces that, and it's right after the halving, it's going to go crazy. It's going to go parabolic. And so the key is turning a profit, buying assets. Okay? And then 3, hold assets, don't sell them, and redirect 90% of your energy into building your brand, building your business, becoming smarter, becoming more intelligent, and making more money, turning a higher profit. Right? There's a favorite saying that I have, and it says, poor people don't sell anything. The middle class sells a lot, and wealthy people don't sell anything. Or they don't sell at all. Meaning they go buy assets and they hold them for 35 years. It's like I was listening to an interview with the most successful restaurateurs from Houston, and I met him a few times. I always stay at his hotel and got some spots for Christmas parties and different things like that. And he's purchased stock in 2008 that he still owns and he never sells. And what the wealthy does is they buy assets. Like, for example, you look at Apple. It's not financial advice, but I have a pretty good indication that Apple is going to be a much more valuable company in 25 years than it is now. Probably Tesla, probably Bitcoin, probably Microsoft. They have all the resources. They have the smartest people in the world. Who knows? You never know what can happen. But what happens is those assets start doubling and tripling and quadrupling, and compound interest occurs. And eventually, your capital appreciates at such a rate that all of your everyday cost, I don't want to say it seems free, but it almost is. Because you start earning so much more money than everyday expenses because you have your money working for you. I have certain friends now that are finally experiencing this, and it's a good feeling. You could work your ass off at your job. And if you have $1 million in an investment account and you have a 5% return on your money, like you have some crazy bull run day that you make 5% of your money, you just made 50 grand. You didn't do anything. You could have been at the beach all day. Think about if you have 10 million in an investment account, you get 5% on your money, you just made $500,000. 10%, you just made $1 million. Bam, like that. That's how wealth is made. Wealthy people convert fiat currency, which is trash. They turn a profit for what they do. They're really great at what they do, and they buy assets, and then all their energy is on growing their brand and their business, earning more money, more fiat currency at a profit, and buying more assets and never selling. And then if you do sell in 20 years, 30 years, it's so small, but it's millions and millions of dollars, or you're borrowing off that money and utilizing that as spending power, or you're living off of the cash flow. So we have to start thinking like investors. When we talk about business, a lot of you guys are business owners, and some of you guys aren't. And I tell people all the time, you don't have to become a business owner. Most people shouldn't, but everybody needs to be an investor. You're like, well, Grant, I think I want to start when I start making this money. I'm about to get this job. My business is about to start making more money. I'm going to invest then. And this is what I experienced and learned, and this is what I want to tell you, is even if you start with $10, do it. Because it's the habits that is key. And the quicker you can start accumulating capital and earning interest on that money, the quicker you're going to see massive returns. And when the habit is there, as you make more money, if you still keep your habits, what's going to happen? You're going to start deploying and allocating more capital towards appreciating assets. And that's where wealth is built. Nothing is more important when we're talking about becoming wealthy and investing than time. And if you do this, and like I said, whatever your numbers are, go click the compound interest calculator. This is just a random site. It's free. Type in your stuff. You plan it, because each one of you guys have a different financial situation. But input it there. And you're going to see the estimation of how much capital you're going to have in 10 years, 15 years, 20 years, 40 years, 50 years. And if you do this the right way and you really develop yourself, you can become rich in 10 years, assuming you do nothing crazy and you make a lot of money. 20 years, you're wealthy. And 25 to 35, you have generational wealth. So hope you guys enjoyed this podcast. Implement this stuff as fast as possible. If you haven't already, there's a link below. Just started a private business community. I think we're up to over 200 people there now. And we do weekly live trainings on all these different types of topics on growing, scaling businesses, sales, investing, persuasion, and just ultimately how to grow as an individual. And other than that, I hope to see you guys soon for the next episode. And follow me at all my social media links at Grant Mitt. Thanks, guys. Hope you have a great week.